I think that people who don't have a position in precious metals equities currently are making a mistake. I think you need to establish a position. Well, I'm embarrassed to say that in terms of my equities portfolios now, my cash position is hovering around 30 or 35% because I've done some selling and I haven't been able to redeploy the cash yet. I would suspect that a more prudent level would be, depending on the cash available to somebody, around 10 or 15%. And I've availed myself of many, many, many options in terms of storing the cash, all of which are lousy. I'm not chasing yield, which is to say I'm not going in long-term obligations because I don't think that the increase in interest that they pay you is worth taking the duration risk. So rather than get paid, as an example, 150 basis points in a 10-year treasury, I'd rather get paid 50 or 60 basis points in a shorter duration treasury, understanding that I don't want to take any capital risk with my cash. If the interest rate rose, you'd get killed in the 10-year treasury. It wouldn't feel like it had been cash to you. So I'm willing to take a much, much, much smaller yield in order to shorten the duration. I am buying silver miners myself because I expect the silver price to go higher. Investors that don't have both the psychological and financial capability to weather the storm shouldn't be in the place. I am talking to investors who at once believe in the thesis so that they will be patient, but also people who can take the relative risk and the absolute risk, both on a psychological basis and a financial basis. I have found that being early, buying things when they were out of favor, when the world to me looked like the price of what I was buying had to go up but didn't have to go up immediately. The fact that I didn't need psychological verification around assets I bought treated me extremely well. If you're the person who asked that question, we'll take them back 3 years ago. Had they held uranium stocks, they would have been through 18 months of absolute agony before the whole portfolio over 6 months quadrupled. The circumstance that I see around silver, and to a lesser degree gold, is very similar. Precious metals are less challenging psychologically than uranium was. When people look at precious metals and they get bored by it, people looked at uranium and they hated it. I would talk about uranium from the podium, and people would come up to me after a public speaking engagement and tell me I was a despicable human being, that I was speculating on Hiroshima, Nagasaki, Fukushima, and 3 Mile Island. At least in the gold and silver business, I draw yawns as opposed to hostility. I think one thing that happens to people around the precious metal sector is when they buy into the narrative, they overbuy. Precious metals can go very long periods of time, 6 or 7 years, and make you no money. But when they do make you money, they make you gobs of money, and they make you that money quickly. So you need to be in place at the beginning of a market, and you need to have a fairly broad range of tolerance for time. You and I have talked for years about the Barron's Gold Mining Index, which I will send to those listeners of yours who are interested. And looking at that index is really instructive. The average precious metals bull market is not like some people think, 2 or 3 years. The average is 10 or 11 years. And those bull markets are punctuated by fairly long and fairly deep market declines, which is to say cyclical declines in secular bull markets. In 1975, as an example, there was a 50% decline that lasted 14 months. People who got shaken out missed a move at the end of that market from $100 an ounce to $850 an ounce. And they missed a move in the equity indexes that was almost double that. So I think it's important that people understand that these markets take time, and that these markets, the volatility in these markets, will test you. I think, too, that people need to examine their premise around precious metals. I believe that a move higher in precious metals is absolutely inevitable. And I believe that to be true for 4 reasons, which I'd like to give your listeners. Precious metals move higher when people are concerned about the maintenance of their purchasing power, their standard of living, in conventional savings instruments. And I'm going to use the U.S. 10-year Treasury, the largest and most liquid security in the world, to represent the range of savings and investment alternatives around Americans. So let's talk about the reasons why I believe that gold and silver has to go up. Is this fear justified? The first fear, which you and I have talked about before, Dunnigan, is quantitative easing. If you did it, if you printed something called a Dunnigan, you would be accused of counterfeiting and you would be thrown in jail. When Congress does it, it's policy, and they become highly popular, and it gets them reelected. But however you view quantitative easing, what it is the creation of new specious currency units that are introduced to float the economy rather than to accommodate the economy. Some observers suggest that the float of U.S. dollars has increased by 40% over 2 years, which is to say 40% of all the dollars in circulation have come into existence in the last 2 years. So clearly, government-sponsored counterfeiting is taking place on a very, very, very broad scale. And if nothing else gives you pause about the efficacy of the currency, the fact that they're printing lots and lots and lots of it for free means that you need to be concerned. Will it catch up with the dollar? Almost certainly. If you create new ones, if you create new supply without creating economic value, certainly you depreciate the value of existing ones. But the story gets worse, Dunnigan. Beyond quantitative easing, there's, of course, debt and deficits, which you and I have talked about in the past, too. Collectively in the United States, we owe each other $29 trillion. Trillion dollars on balance sheet. Now, net of the Fed's own balance sheet, that's only $22 trillion. But that's on balance sheet. We also have off balance sheet liabilities, Social Security, Medicare, all those things. I'm not going to get into a policy discussion. All I want to say is that the off balance sheet liabilities, net present value, are $120 trillion plus. And we propose to service this debt with a budget that's in deficit this year, probably $4 trillion. There's a little poem that I'd like your listeners to remember. When your outgo exceeds your income, your upkeep becomes your downfall. And people need to understand that servicing $150 trillion in debt, where your aggregate household income is more than $4 trillion a year, is a challenge. And so people look at this and they become concerned about the efficacy of their savings too. But it gets worse. The worst is negative real interest rates. Negative real interest rates are not a force of nature. If they were, Dunnigan, you would happily save, forego consumption, and lend money to me, and pay me to consume now and take on the credit risk. This is totally insane. But the arithmetic around the world's primary savings and investment instrument, which is the U.S. 10-year Treasury, documents this. The U.S. government will borrow your money for 10 years, and they will pay you 1.5%, 150 basis points.